we follow kind of the same loose time frame, it'll be in the summertime. So gold and silver may kind of, now that they're back in their range, may just kind of bounce around between 20 to 25 or something for silver, and gold between 1,700 and 1,800, that kind of thing. But man, when they start cutting, and they will, man, that's when everybody, the curtains pull back and everybody realizes how full of crap these guys are. And then up we go again. I've been thinking of late as to whether some of those actors have left the stage. It used to be, when I first got involved in this in 2008 and 9, and then through 2012 and into 15 and 16, you'd just be sailing along, and in the middle of the day, the bottom would just drop out. Or at the most odd times, whether a Sunday evening or like a Tuesday at 10 o'clock Eastern, something like that, all of a sudden, there'd just be this rush of volume, compared to any other times of day, and then boom, price just falls like $20 in gold, and 60 cents in silver. That doesn't happen anymore, or at least infrequently, or at least less frequently than it did. And so I wonder if a couple of things have actually had maybe a greater impact, or maybe the impact that we'd hope. One being the Basel III changes, trying to force these banks out of that paper game into more physical. But then also those convictions at J.P. Morgan and the almost $1 billion fines that they had to pay. I mean, when you take the former head of precious metals trading for J.P. Morgan and you convict him, and I don't know if he's been sentenced yet, but Michael Nowak is still awaiting. I mean, he may end up doing some time in the hole for overseeing that operation. Put those things in there, we might be seeing finally banks stepping away from that. I mean, I just saw a news article as we record this morning about HSBC had decided to get out of the industrial metal business altogether a couple of years ago. Now they just petitioned and quit the LME this month, here in December. So the manipulation part of it, and again, much of that I always felt was just done by bank trading desks for profit because they could. That may be easing. In this turnaround this fall, silver has led the metals and the miners down as the dollar rallied. But silver also bottomed first. Silver bottomed back on the 1st of September, where gold really had this kind of floor that it put in October and November instead. And so silver, where it let everything down, has been leading things back up, gold and the miners. And that may very well continue. Part of this bottoming process in silver is we were able to monitor the hedge funds that trade silver futures get extremely short 4 times in the last 90 days. In doing so, they left what are called the swap dealers on that category in the Commitment of Trades report. And what are swaps? Those are futures and options. Those are derivatives. And who deals those? The banks. Okay, so the banks were getting long while these hedge funds were getting short. Well, that's just an inverse of what we've always seen in the past, where the banks are short and the speculators are long, and then the price drops out and they get ruined and the banks profit. Well, hey, lo and behold, 4 times in the last 90 days, those speculators have been ruined by spikes to the upside, short squeezes. So there are some, these kind of fundamental kind of ancillary changes that are kind of taking place in the structure of how this works. Now, whether that'll continue, we'll see. If price rallies as I expect next year and into 24, how actively will the banks supply the short positions that the speculators take long? We'll just have to see. If they don't, that could exacerbate the moves to the upside. But I do sense less intervention on a grand scale than what we, saw all the way, up until a few years ago. So it'll be interesting to see if that continues. If anything, it's a good exercise for me to kind of take stock of what has happened and then to look ahead. It's very unfun. I can tell you that, because on years where I've done a good job, like 19 or 20, all you get is, well, anybody could have seen that coming. You're nothing special. And then in years like this year where it didn't work out, I mean, I thought we'd be rallying into year end, and we are, but I thought the lows would come like in May or June, and then we'd rally back toward 2000 by the end of the year or even past. And like I said, that's all been delayed, and now all I get is, trolls telling me what an idiot I am. So it's not a very rewarding thing to do, but I do it anyway. And so as we get into December, I start to kind of collect ideas and screenshot things, as reminders so I don't forget about some of the fundamental stuff I've noticed. And the idea is beginning to crystallize in my brain that this upcoming year will be a lot like 2010 and 2019. Now again, if the war in Ukraine goes crazy and all of a sudden for example, that big nuclear power plant, wherever that is in Ukraine, suddenly has a meltdown and, God knows what can happen, right? War in Korea. So you try to look at this from a macro perspective and say, okay, on a predictable level playing field, here's what I think is going to happen. In 2010, we were coming off of the first QE program that changed everything. The trend line in the S&P goes back to March 2009, okay? That was a paradigm-shifting event. But as 2010 began, you were being told, everybody was being told that was a one-off, Jesse. They're never going to do QE again. It was just done to, help the bank get out of the financial crisis. And through the first half of 2010, all the way into the fall, gold and silver really didn't do much. But with QE2, which suddenly appeared in November of 2010, bang, silver goes from 18 to 48 in about 6 months. Silver, gold soars and all that stuff because everybody figured out the Fed was full of crap. So fast forward, we go through all these next intervening years where everybody's talking, oh yeah, the Fed's going to pull down the balance sheet, all this kind of stuff. We get to 2018, after 6 or 7 years of wandering in the desert, and even though interest rates had spiked to 3.25 on the 10-year and the S&P had crashed by 20%, as we entered 19, there were still all these 8-figure Wall Street economists like Jan Hatzius at Goldman Sachs saying that the 10-year note was going to go to 5% in 2019, and the Fed was going to keep hiking. Well, instead, the Fed had paused and begun to pivot in December of 18. It took about 6 months before they actually started cutting. The first half of 19 was pretty quiet for the precious metals, kind of chopping sideways. And then, when they started cutting in June, from June to September, gold went from like 1280 to 1580, about 25%. Silver took off, all that kind of stuff. And then we know what happened in 2020. It was all, the printer was going again. All right, so now here we sit, the end of 2022. And there's still all these forecasts, all these, Jan Hatzius is out there again, talking about 5 and 6% on the 10-year note, and Powell's trying to tell you, I don't see any rate cuts coming at all in 2023. Just like a year ago, he didn't even see any rate hikes until 2023. The recession that's coming is going to be sharp. The Fed is going to have to pivot and start cutting next year. We follow kind of the same loose time frame. It'll be in the summertime. So gold and silver may now that they're back in their range, may just kind of bounce around between 20 to 25 or something for silver, and gold between 1,700 and 1,800, that kind of thing. But man, when they start cutting, and they will, man, that's when everybody, the curtains pull back and everybody realizes how full of crap these guys are. And then up we go again. Then the only question, I'm 100% convinced of that. The only question is, will the overall market, the institutional investors, the hedge funds and the like, buy with the Fed selling again by 2024 when they start talking about hiking again? Because if they don't, then we get into this late 70s kind of period, where things just keep going up. And that's certainly a possibility. I titled my 2019 forecast, I called it 2010 plus 9, in that 19 was going to be like 2010. The working title for next year's forecast might be 2010 plus 9 plus 4, something like that, in that 23 is going to look a lot like those years.